Hi everyone, I'm Annissa and this is Whale FM's Project Showcase. In this show, we talk with founders and projects in the crypto and NFT space, otherwise known as Non Fungible Tokens. My guest today is Jamie Burke. Jamie is the
Hey
founder
there.
and CEO of Outlier Ventures and a well-known face in the industry, regularly speaking at conferences around the world and advocating for the professionalization of the industry in media like Forbes, Wired, Reuters, and CNBC. Outlier Ventures is Europe's first blockchain venture builder and early-stage fund that pioneered the convergence thesis, blockchain as a fundamental to key emergent trends like AI, IoT, mixed reality, and autonomous robotics, with huge significance to health, eGovt, Industry 4.0, mobility, smart cities, and Finserv. Please enjoy. Hi, Jamie. Thank you so much for coming on. And to start us off, I'd love to hear a little bit about your background and how you first became involved in the crypto and the blockchain space.
Hey there. So thanks for having me on. It's a pleasure to talk to the Whale community. Big fan of everything that's going on there. And of course, Whale himself. So I've been Outlier's been around for over 7 years. I guess I've been personally in the space for maybe about 8 years. As you can imagine, over that period of time, for those that have also been around for that long, the space has matured a lot. It's gone through its various cycles. And so, as you can imagine, as an organization, we've really evolved with it. So in the early stages, we were a studio because, to be honest, 7+ years ago, there weren't really many startups to invest in that were truly native to the space. You'd maybe buy a bit of Bitcoin and then eventually ETH. But other than that, that was pretty much it. And so I brought on a CTO called Aaron Van Ammers and said, look, we don't really know where this space is going. It feels important. So let's just get some applied learning. And so, we broke stuff a lot, basically. And a lot of the things that we were building, we never really intended to, commercialize as businesses, but we would get this applied learning and that would ultimately make us better investors. And the consequence of doing that, the space matured a bit more, and I think we spoke to like 1,000 startups way back when everybody was kind of layering on blockchain to their startup and pitching themselves as a blockchain startup. In reality, they hadn't fundamentally changed anything about the business model. It was a classic Web 2, proprietary business play, trying to be a platform. So at that point, we decided, look, there were a lot of use cases, people that were talking about how they were conceptually going to be using blockchain. Very few had fundamentally understood the paradigm shift. And even if they had, the technology, the infrastructure just wasn't there to execute on that particular use case. And, you could argue that that's only just becoming true now. So we decided to focus primarily at the infrastructure layer. And so we became more of a incubator for protocols, much lower down in the stack, that were building foundational primitives. And as you mentioned in your introduction, we were primarily looking at Web3 at that point from the perspective of it being a new data economy. So how data is produced in terms of the context of IoT devices, how it's then distributed and commodified using distributed ledger technologies and of course digital assets, and then ultimately how it was going to be consumed by machine learning and AI. And so that was kind of the framework and framing, and we looked at the convergence of those technologies. So I think you mentioned it again in your intro. We called that the convergence thesis, and that led us to invest in things like Ocean Protocol. Way back we were looking at IOTA and in the context of IoT devices and the machine economy, machine-to-machine economy. But then that has continued with us over the last several years into things like Fetch.ai, which is some of the DeepMind guys looking at machine learning, autonomous economic agents. But then also things like Secret Network, which is, kind of privacy computation, privacy preserving computation and these kind of things. And then more recently, Dia Data, which is kind of curated, crowdsourced data oracles, as well as Kudos, which is distributed compute. So you could imagine what Filecoin is to storage, decentralizing the cloud, these guys are doing for compute. So that was really our play in terms of protocols and infrastructure. And then about 2 years ago, we felt that generally the Web3 stack was maturing enough and that we could begin to start investing at the middleware layer and the application layer. So middleware in terms of making all of this stuff usable for the 99% of developers. When people talk about adoption, they always think about that in a consumer context, but 99% of the world's developers still aren't building anything on a blockchain, on any blockchain. So we've invested a lot in startups and protocols that abstract away the complexity of building startups on top of blockchains and sometimes combinations of blockchains, and abstracting away a lot of the complexity there, both technical and economic, because of course a lot of these things have their own native token. And then also at the application layer, where we've begun to focus more on NFTs and DeFi. So, we're now, for the last 2 years, we've been focused much more as an accelerator, primarily at the application layer, but with a bit of middleware. And we're working this year, we'll work with 50 startups. We'll accelerate 50 startups. Half of them will be NFT related, half of them will be DeFi related. And of course, many of them a mixture of the two, where NFTs are a form of collateral in DeFi. So I know that was a lot, but basically that kind of summarizes where we've been at. And then more recently, we've reframed our thesis as the Open Metaverse OS. Mm-hmm. So this is specifically looking at forward another 10 years. So normally every couple of years we write a new thesis. The most recent thesis, which is the Open Metaverse OS, you can find it on a website, which is outlierventures.io. Mm-hmm. This talks about how Web3 infrastructure, things like self-sovereignty of identity, of data, self-custody of digital wealth, privacy preserving technologies, NFT and DeFi all combine to make the capabilities of an open metaverse, as opposed to a closed metaverse, one that's dominated by all these web platforms, gaming engines, etc. So happy to talk about that a little bit later.
Yeah, when you mentioned infrastructure, it's interesting because I noticed in one of your talks, you spoke about how a lot of these projects or businesses, they think about the project, but they don't think about the middleware, and they go directly straight to the user. So they don't really think about anything in between. So it's interesting that you mentioned that. And in terms of creating a business, I know that you spoke about, breaking things. So that would be blitz scaling. So in terms of creating a business, right, what are some of the core principles in creating a sustainable business model when, doing in Web3? With so many new technologies coming up, it's hard to predict what's going to happen in let's say even the next 10 years and even the next 3 to 5 years, because everything is coming up so quickly. And so, what are the best protocols to kind of increase that adoption curve to the mainstream audiences? And like you said, even if you manage to predict the right protocols, or you do the right moves, you can also lose a lot of money if, you're far ahead and no one can catch up. So what is the right business model to start a project in this space with how the Internet of Things is in right now?
Yeah, so it's a good question, and there is no one right answer. So, of the 30 startups that we accelerated last year, some of them look a little bit more like classic startups in that they, have a business, they have staff, they have equity. And then others, there is no business, right? They're effectively a protocol, a network, and, they finance themselves and they optimize that network through tokenization. And then some are a hybrid of the two, and that they might be a hybrid of the two sequentially. So they might start out relatively centralized as a classic business, and then they might increasingly devolve more of their activities, governance, etc., to the network. So there is no one right path. It depends, as you say, on a number of things, a number of dependencies that might be specific to that use case, technical dependencies, like a dependency upon Ethereum or any other protocol. It might be dependencies specific to the stakeholders that they want to engage, their customer base, the customer base's perception of crypto. Are their end user already native to the space, like in DeFi? And even in DeFi, you could argue it's still a very small subset of crypto that uses DeFi. It's still incredibly complex to use. It's not user friendly. It's very difficult to manage risk. So, with all of these startups that we work with, we help them to take a very pragmatic pathway. So the first thing is that they need to acknowledge that they are building in a new paradigm. And it's amazing how many startups are building in an old Web 2 paradigm. They're trying to build proprietary platform-based businesses, primarily financed by venture capital. And they're trying to do a winner-takes-all market. And in reality, as I'm sure everybody on listening to this would appreciate, there are many things that have changed about the web or are in the process of changing, which fundamentally mean that it requires a different business model. It requires a more collaborative, more open business model. And so, the technical decisioning, we have some startups that come into the space that have a very, they've already built their product. They already have chosen their technology stack that they're building on. Others might be much earlier in the process and are still trying to kind of decide how they're going to make all these decisions. So really our job, at least in the accelerator, is to kind of help them fast track decisioning, to understand what is important and critical to them to be able to gain traction and adoption. So on the one hand, as a startup, nothing's changed, right? You need to find product market fit. You need to establish that people actually need the thing that you're building. And they intend to use it in the way that you hope they're going to use it. And when you're doing that, you want to be relatively centralized, right? So you don't want to decentralize the governance for a startup that hasn't established product market fit, because if you follow all the ideas around lean startup principles, you want to be able to iterate rapidly. And that requires a small group of decision makers to be able to make data-led decisions and to iterate product until you establish fit. So in this sense, it makes sense for startups to raise money through equity, to have a core team that are staff that are working exclusively on a project, and to take in, private capital. Right. Once they've established fit, and they at that point, you can potentially begin to open up the network. You can open up the source code. You can devolve perhaps more governance to the network. And often this is kind of called a pathway to decentralization. And most projects, even projects that you would perceive as being very decentralized, like MakerDAO, have had a pathway to decentralization that's just happened organically. But we help them arrive at that in a very structured way. And because we're typically working with early stage projects, the key thing is that they achieve what you would call a flywheel. So you want to focus on a number of outcomes that catalyze one another. So they reinforce one another and they build up momentum. And that is momentum around user adoption, which then informs, your fundraising capability and vice versa. So a lot of the time when we work with startups, it's actually reducing down their design space. It's shortcutting decisions such as, well, actually, if you're going to roll out your MVP, maybe you roll it out. It could be leveraging Ethereum or another protocol like Matic, layer 2 solutions, in order to remove friction for adoption. Now, some of these things might not be long-term sustainable. They're kind of shortcuts, but effectively, you don't want to make dogmatic design decisions that basically provide a point of friction to, especially if you're building a business, like an application, of people using that application, right? You want to make it as easy as possible for them, as cheap as possible. As it needs to be fast, cheap, and better than what they're currently already doing, or allow them to do something they've never done before. And so at that point, you want to be relatively centralized. You probably are having a number of technical workarounds due to the limitations of the Web3 stack. And then once you've established that, you've raised enough money, at that point, you can start to make kind of more long-term design decisions, both in terms of technology stack, in terms of how something could be token optimized, and governance. And then you kind of create these long-term pathways for how you begin to execute on those.
It's interesting because in the traditional market, when creating a business, you have these model market fit, like market product fit, product channel fit, and channel model fit. But then, in this, in Web3, or when you're creating tokens, or doing DeFi projects, you have to do network fit, market fit, and there's a bunch of stuff that goes with it. And I remember in one of your talks, you talked about, centralized and wet, and one far end of the spectrum, and the other was decentralized and dry. So I'd love to kind of understand what that is, with the convertible nodes, with tokens, programmatic, like inflation scheduling and all that.
Wow, you've done your research. That was written quite a while ago. So yeah, so as you say, centralized, decentralized, dry and wet. Dry is when you're devolving decisions and operations to code. And obviously, you don't want to commit something to code until you've verified that it works. So, this is classic startup stuff. You basically do things manually until you know it works, and then you codify it. And the same should be true around pretty much most of the considerations with Web3. You want to test, validate in a manual way so you can correct, and then you can codify. And once codified, you can devolve. So wet is obviously people. It's meat making decisions, and then you can begin to devolve things. Both you can increasingly decentralize them, and you can devolve them to code. But like every project really needs to kind of map this out, often over at least a 3-year period. And every startup, like the very concept of a startup is you are experimenting. The startup itself is an experiment, carrying out a series of experiments where you're validating assumptions. And then, once you've validated it, you're looking to kind of scale. And the key thing with all of this is, token and token design. So one of the things that we always really advocate for is a minimal viable token. Over the years, we've seen lots of projects that have raised lots of money that have tried to build the perfect system that nobody ever got to use, right? For various reasons. The market moved on, new innovations happened, they run out of money because the market changes, the market cycle goes from a bull to a bear. So the kind of key things that we always recommend, especially in a bull market like now, is take as much money as you can off the table, get it into fiat, don't hold it into, Bitcoin or crypto, get the money that you need to execute on a 3-year vision. Because that way you can be a evergreen startup. Like, it doesn't matter the cycle of the market. Even if you've got a token live, you're not reliant upon that token to finance yourself. And then really you can think about getting a minimal viable token out. And the purpose of a minimal viable token is from an engineering perspective, and there's lots of really great thought leadership done here from the token engineering community by people like Michael Zargam or Trent McConaughey, both good friends of Outlier, where you apply engineering principles to token design. And ultimately that is, if you're trying to design for something, you want it to be as simple as possible. The more complexity, the more things you try to get something to solve for in an engineering context, the more fragile it is, the more likely something's going to go wrong, or there are unseen circumstances. So you want to reduce complexity. So the idea with a minimal viable token is, what is the minimal level of utility where the token can optimize a particular market economy and network? And so, if you put aside thinking about the token as a means of fundraising, and you think of it as a thing that can optimize for behavior in a network, that can either be incentivize positive behavior that you want to see, or disincentivize as a cost negative behavior, you then end up with an optimization function. And you want to take that to such an extreme extent that you should be able to express that optimization function, the thing the token is optimizing for in a network, in a mathematical formula. And if you can do that, what it means is you can measure it. You can measure it if it's doing what it should be doing, and you can figure out, you can either simulate or kind of, live edit, live experiment with ways of trying to optimize the formula in order to get a better outcome. And so a big part of what we do, which hopefully is apparent now, is we have startups join. They could be a fundamental primitive in, say, d-commerce, decentralized commerce, or the metaverse, NFTs, DeFi. They often come in with complexity. They come in with a very large design space. Right. They're trying to solve for lots of different things. And our job at that stage in their cycle is to reduce all that down, get them to focus on often 3 key things that then inform this flywheel. And if they can begin to evidence traction, which might be user growth, it might be revenue, it might be other metrics, right. They can then begin to fundraise at increasingly aggressive valuations. Their ability to access capital cheaper than the competition means that they can scale more quickly. But then they feed that investment back into the flywheel, which is about growth. It's about product growth and traction and fundraising. And ultimately, the purpose of fundraising is being able to raise more money more cheaply than anybody else. Right. And the consequence there is that you can outcompete the market, but it does require that kind of discipline. And so a lot of the startups that join us they are smart enough to, as entrepreneurs, to acknowledge their weaknesses and what they don't know. Right. But they're also disciplined enough to reduce complexity and, kind of achieve a greater level of focus.
Yeah, and speaking about as a venture capital, right? You see a lot of businesses, and you every day it's like probably just meetings and meetings with just the founders, and so in terms of like identifying opportunity in the market, I've heard this argument, why go into a competitive market when there's underpenetrated markets, and it's because there's already like an adoption curve. People have already adopted the behavior, and there's a growth trajectory. And it's actually a phenomenon that is oddly undervalued. And so, what are your thoughts on that, of like actually investing in a very competitive market and actually just going for the top 1%, let's say, because you're buying behaviors that are already built out?
Yeah, so you're right. You can take a couple of different approaches. You can go for, people always talk about red ocean, blue ocean. Right. Red ocean being bloodied because it's highly competitive, highly sought after. Blue ocean being, kind of this virgin territory. So as an accelerator, like, we have a very specific role in the ecosystem, unlike perhaps a later stage venture capitalist. So our job, last year we spoke to about 1,200 startups applied to the accelerator. We think this year it'll be about 2,000. Now, and we'll only work with a small fraction of those. So as I said, this year, probably about 50. But one of the byproducts of seeing that many early stage startups, you've got to remember probably at least half are pre-seed. So they're like 2 or 3 people. They've got a very early product. One of the benefits to that is we probably have one of the best views on the market, because we see what's coming before most VCs. Like, that's just too early for most VCs to even have a conversation with them, because they just couldn't give them 1, 2, 3, 4 million, even if they wanted to. And there's too much associated risk. They've not established product market fit or whatever it may be. But the consequence of just having those many conversations is you start to see patterns. You start to say, well, shit, 15% of those startups are focusing upon this particular problem area, this particular market area. So you get a feel for momentum of innovation, which is obviously great, and that helps inform our thesis. So that's why we've always got, a pretty edge-based thesis, just by virtue of us seeing the market slightly ahead of everybody else. And, if you're talking about people that are investing in the secondary market, in terms of crypto assets, it's sometimes 12, 18 months ahead of the market, the projects that we're kind of bringing through. Now, the kind of function that we play within the overall ecosystem is, it is our job to filter the startups that have potential, and then feed them into our co-investor network, which is the later stage VCs. And that's angel networks. It's now, of course, because the bull market's back, crypto pools, increasingly DAOs, but then also like established, VCs of, all kind of pedigree, all the way up to like the Andreessens of the world. So our job is to de-risk investments for them and to find the best talent to help them focus on de-risking that investment and make sure they're well capitalized enough to move to the next stage, which is either, closing their seed round, being able to move towards their Series A, launching a live network. We'll probably help launch 20 live networks this year. We're going to be doing probably one a month, at least one a month in this next quarter or two. And then we've got a load more coming later down the line. But the challenge as an investor is that, so where previously in the early days, we were kind of just investing in things that we knew would happen, that we wanted to happen as an incubator. So Fetch and Ocean are a really good example of this. So we invested in Fetch, God, I don't know, 4 years ago, and Ocean probably 3 years ago. And they're only just now starting to get the attention that they deserve. They were arguably, the whole data economy concept was ahead of its time. Now, that's not a good thing for us as an investor, because we need these things to get more capital to survive. Now, fortunately, we help both of those projects to different degrees raise money. With Fetch, we helped them do their token sale in 2017. And we made sure, coming back to this evergreen concept, that they were well capitalized enough to ride out the crypto winter that followed. And so now, they've got a token that's doing really well. They're able to fully finance themselves and they're scaling. But it's taken a while for a lot of the rest of the market to kind of catch on to that investment. With an accelerator, it's a very different model. We work with a project. So with Fetch, we worked with them over 3 years. We're still working with them deeply now. With an accelerator, we work with a project intensively for 3 months, explicitly to close a seed round. And so the things that we invest in and bring into the accelerator, we need to know aren't just a good startup, but that are going to be relevant to what other investors are looking at as a market in 3 to 6 months. And so it's no good for us or the startup if we accept them into their accelerator and they're too early. So one of the things I've really learned over the last 7 years is you can be right, like your thesis can be right. You can even make the right bet on a startup, like the team and everything else, but you can get it wrong by being too early. And so like our sweet spot is actually to be 6 months ahead of the market. Anything more than that, and the project will struggle to raise from other investors. And anything, I would say, at least 6 months, the closer the better, right? So we've got some projects that we're working with much later stage, and they're 6 weeks away from launching a token network. So they've already raised a massive seed round, but it is a difference between them going out at a 20, 30 million market cap and $1 billion market cap. So we've had $2 billion market cap projects out of the gate. In the last 12 months, we've had 3 that have been over 600 million. And honestly, the difference between a project that goes out at 30 million and that isn't much. It's often down to making sure that the market perceives them in the right way. And so that's also kind of a big part of what we do.
Is there any investment principles, I would say, when identifying these opportunities in the market, to identify companies that actually have tailwinds instead of headwinds?
Yeah, well, I always describe it as a slightly different analogy, which is sometimes you're swimming upstream and downstream. And you can really feel it. Often it's very difficult for the entrepreneur. So if you're alone, and before I was an investor, I was also an entrepreneur, and sometimes you really believe in something. And as I said, it's kind of inevitable, like somebody will do it, but it feels like you're swimming upstream. Like for some reason, you're not getting the traction. Like what you're saying isn't connecting with investors. You're not really kind of closing customers. You're not establishing fit. And sometimes it's like very difficult to understand why when you're doing that in a vacuum. And being a startup founder or a group of founders is a very lonely thing, right? So this is one of the benefits of being in a cohort. So a cohort of 10, like you can see the difference, like immediately within weeks, you can see the difference between upstream and downstream. So for example, we've got one project in a cohort that will announce imminently. They just closed 3.5 million seed within halfway through the program. They weren't even raising that much money. And they've got like a who's who of investor coming in. Similarly, we've had a project like Boson Protocol. We actually accelerated in the depths of the crypto winter. So I don't know, over 18 months ago now. And, Justin and the team, like no one was interested in what they were doing. They basically solved a massive primitive for e-commerce, which is how do you solve for physical to digital to physical redemption? So if you own an NFT that's associated to a physical thing, how can you be sure just because you own the NFT, you're actually going to get the physical thing? Right. So they created a really elegant primitive that solves that problem. It abstracts the complexity away, and that all of a sudden makes possible de-commerce, decentralized e-commerce, which is going to be massive for NFTs. But 18 months ago, nobody was talking about NFTs. So even though we knew it was huge, they knew it was huge, like they couldn't raise any money. Right. Fast forward to the summer of last year, and we were still working with them on how they communicate it. And I think we kind of landed on, Boson is the cornerstone to de-commerce that stable coins were to DeFi. It's the thing that catalyzes the whole thing. All of a sudden, they were closing several million. They're now 4,000% oversubscribed in their private sale round, the first private sale round they do. They'll be doing a live network this quarter. So like timing's a really big thing, and memetics, like in crypto and Web3, it's all about memetics. It's about the meme. It's being seen part of the meme. You can't manufacture that. There's just like it's catching a wave, right? And that's the hardest thing for a founder to know, like whether they should continue swimming upstream with whatever it is, or they should pivot. And again, that's a big thing that we do in Accelerator. We've had several projects, like a week into the program, we put them in front of 50 investors back to back. Like some days they speak to an investor every half an hour, all day. And at the end of it, they've got a pretty good feeling like, shit, nobody's buying what I'm telling them. So what do we do? And we sit down with them and like, is it just a messaging thing? Or actually, do you need to fundamentally pivot your business into something else, which could be adjacent? We've had some teams do entirely different businesses. It's rare, but sometimes it happens. And this is why a big thing for us with our accelerator Basecamp, which by the way is outlierventures.io/Basecamp, is we back founders often. If it's early stage projects, we're backing the founders, not even necessarily the thing that they're pitching us, because it's likely the thing that they're pitching us is going to pivot. And so like you want to invest in people that are going to they're going to hit the jackpot at some point with something. And our job is to kind of help them iterate to achieve that. Of course, if we're dealing with later stage projects, and that's something called ascent, you'll notice this mountaineering analogy. Basecamp is you're at the bottom of the mountain, and ascent is, you're on your climb. With projects that we work with in ascent, they've already raised several million. They've already got a product. They've got a well-designed token. They've simulated and modeled how that's going to optimize the network. And often for that later stage, it's much more around positioning and making sure that the market understands their value proposition. They understand how value will accrue in their token, how it's fundamental to their network, and all these kind of things.
So it's interesting because, you mentioned that, it's with Accelerator, it's kind of, in meeting with these, these investors, it's kind of validating whether what they see and whether the market actually agrees with it. So it's interesting with that point. With the internet, half of the people are kind of bots already, as you know. So are we really building for people, or should we shift our incentives, like our incentives and incentives and the gamification of the systems to machine instead?
Yeah. So again, you've definitely done your research, right? So I was talking about this probably 2 years ago, because it was central to this thesis around the convergence stack and machine learning and AI. If you subscribe to the idea that firstly, Web3 is primarily about data and a data economy,
Right.
and you accept that everything that is digital is effectively data and metadata, then it's natural to understand that increasingly the thing that will be interacting with your token and your network might not be a person, it might be a thing, and a thing with increasing levels of intelligence and economic autonomy. So, I mean, it could be a dumb device, it could be a dumb bot, but equally it could be something much more complex. And so, and this isn't some distant future. The reality is that I think that already the majority of web traffic on the internet is from bots. It's not people. The question is, who do these bots serve? And so at the moment, they're primarily malicious. They're carrying out malicious activity in a network, and that's because there is no cost to being a bad bot. You can like spam a website and crash it. You can do various attacks. You can have trading bots that are kind of doing various malicious activity. So you're absolutely right that when you're designing a tokenized system, you increasingly need to be thinking about that a stakeholder group in that system could very well be bots, malicious bots, and operating at scale. And so how do you constrain these? And this is one of the great things about tokens. People always think about it as incentives. One of the good things is about disincentives. If you look at the attack vectors within a particular network, bots is one of them. And by having a cost, even if it's a low level cost to carry out activity in the network at scale, means it could cost you millions, tens of millions of dollars to try and attack the network. And as we know with things like Bitcoin, that 51% attack is cost prohibitive to actually carrying out the attack. The incentive, positive outcome isn't worth the cost. And so, you really want to start kind of designing for that. But I think also it raises questions around, there is also an opportunity there. So I think increasingly people will devolve things to bots once they know that a bot is not serving a platform. So for example, bots on Facebook primarily are either serving an app developer or Facebook. They're not serving you as a person. Often they're looking to extract value from you, your data. They're looking to resell it. They're looking to retarget you with ads, or something much worse. But actually, as we can begin to have, smart contracts aren't that smart at the moment. They're pretty dumb. They can carry out very basic logic on chain. This is why we backed Fetch.ai, by the way. They've built something which allows for greater levels of complexity in smart contracting, but also computations to be carried off chain, but in a provable way and in a trustful way. But effectively what that then means is I can devolve more logic, more economic activity to bots because they can have economic agency. So Fetch have actually allow you to build autonomous economic agents on Ethereum, on Cosmos, I think soon on Polkadot, where effectively you can say, I'm going to allow this thing either individually, one agent, or kind of a swarm of agents to carry out economic activity on my behalf. They can buy and sell things, basically. So let's say that could be data, right? I entrust my data that I now have because I have sovereignty of identity and data to a bot. And I can say, you can make that data available in return for money, but on certain terms. And so I can trust that agent is serving my interest. It's not serving the interest of a platform, and I can begin to monetize my data. And I think increasingly we're going to, like, the idea of the web to date is where you manually go onto Google and type in, I want X, I want the cheapest X, or the best X, or the quickest X, like a ticket or a product. I think we're going to get to the point where very quickly I can just ask my agent to go and find me, like, probably verbally through my device, not Siri, not Alexa, because they serve Apple or they serve Amazon, but my own agents, and I can say, go and find me the best price for X, and it will just find me the best price for a ticket for a flight. Like the idea of analog, digital, like digits, fingers, typing things in, and trying to navigate ads and trying to determine what is actually the best thing for me versus what this ad's telling me. That whole ad business will be dead. My agent will go and get me what I need, and I might have a specialist agent for travel booking. I might have a specialist agent for logistics that might work with my travel agent to organize a multimodal form of transport. So we are moving towards an agent-based web, and the key thing is, is the agent-based web serving us as an individual, i.e. user-centric, versus serving a platform being platform-centric?
Yeah, no, because I remember you mentioned, it's about like the convergence in this new data economy. So it's like the commodification of data, and the exchange of information goods and satisfying a knowledge economy. So it's like establishing identity basically on the web, and that would be essentially the first step. So I would love to ask you, where are we at in the Internet of Things? And because I say that I've said that word before, and people go like, is that an actual term? And I go, yes, it is. And what are some issues that we face in terms of the application layer and the protocol layer at the moment?
Yeah, so there's the reality with IoT is that there are probably better people to interview about it, because there's a lot of considerations around, say, hardware, right? But I had a really interesting conversation recently with NVIDIA, who are obviously a big kind of hardware provider in the gaming space. And they're working on a lot of software in the context of the metaverse and how that interacts with hardware devices. And that they're already thinking about things like NFTs. And so I'm really interested. I'm not interested generally in IoT. In the past, we were looking at a lot of industrial use cases. What I'm most interested in now is a new form of convergence in the context of the open metaverse, which is things like AR and VR. So how does this mobile device that we've got, how does that interact with the metaverse? And so for example, if you look in the context of NFTs, and if anybody's working on this, DM me on Twitter at Jamie247. I will give you money. You've already got on hardware devices LiDAR technology, at least on the latest iPhones. So LiDAR technology is effectively computer vision. It's what's used for self-driving cars, but it allows your device to effectively map a 3D space, including 3D objects. And if you haven't tried it yet and you've got an iPhone, I implore you, go download several different apps. You can pretty much scan your room now in 3D just by moving your phone around. I could probably do this room I'm in now in 15 seconds. I have seen it done in like 5 10 seconds. I could scan this whole room and have a 3D model of it. Or alternatively, I could have an object. It could be a bicycle, right? A racing bike or a trainer. I could 3D model that right now, turn it into a 3D file, and through things like NVIDIA and a number of other open source solutions for 3D modeling that are used in both gaming engines and game development, I can create a digital instance of physical space or physical objects. Now, at the moment, that hasn't been connected up to NFTs, but I'm super excited about the idea of having an app on my phone. I've just bought an object, or I've got my house or a building, or I see an interesting bit of graffiti on a wall. I can scan that using LiDAR technology on my mobile phone and instantly mint it as an NFT and sell it in the secondary market. Or use that as a bit of furniture to populate in Decentraland in the virtual world. So for me, I'm most interested in what you might class as IoT devices, physical hardware devices and how that can begin to interplay with the metaverse and virtual spaces. The definition of the metaverse is that there is a blurring between the physical and the virtual. They become one and the same. And so you need that. How that will happen is through devices. That's either, VR or AR headsets that you put on your face that allow you to either go into a virtual space or have a augmented reality layer on the physical world. Or it's about how I can transfer, I can digitize physical things, turn them into virtual things, and not just a 3D file that is just a classic 3D file, but actually something that I can buy, sell, and use to populate the virtual world.
Right. What do you think are some dogmas in terms of startups and developers have in the space? Because I feel like now there's kind of a lot of people with these, like, I make a project, I make a ton of money, and then that's it. So I would love to know.
Yeah, well, so I think there are two questions there, right? One is what are the dogmas that are potentially problematic to innovation in the space? And then I think the other one is, what is the effect of easy and cheap money, right, on entrepreneurship and innovation? So specific to the question around dogma, I think we collectively, everybody listening to this are early innovators or adopters of Web3.
Right.
And we're well ahead of mainstream and mass adoption. And many of us are architects or investing in people that are going to be architects for the next phase of the web, which I kind of refer to as the metaverse. And I think that there are really important design decisions that need to be made and things that need to be considered. And so, there is a lot of dogma around like a hardcore libertarian principle around absolute decentralization, around absolute privacy, this idea that, we need to obfuscate everything.
Right.
And I, of course, agree with principles of decentralization and principles of privacy. At the same time, if it's taken to its extreme, what does that mean for the world? There will be huge socio-economic consequences. I'm old enough that I was around at the beginning of Web 2. I had the first social media agency, or second social media agency in Europe. And at that time, everybody was running around, myself included, saying social media is going to disintermediate news agencies. It's going to democratize information flow. The world's going to be better. And we then had the Arab Spring, and everyone thought this was going to be a flowering of democracy across the Middle East. The Middle East is fucked, right? And it's fucked because we didn't really think through the consequence of that. You can look at what's happening with this polarization of politics now as a consequence of social media. So social media has had a net positive outcome, but it has had some disastrous consequences on society, on the internet, on culture. So I think we need to also think that through in the context of what we're now building before we unleash it into the world. We can't just we can't have utopic thinking that everything we're going to do is going to lead to a better outcome. Right. So that addresses kind of the dogma, I think. And I addressed some of this stuff earlier about decentralization. I think increasingly this is becoming less of a thing, but this idea of decentralization is something you work towards. Of course, there are greater pressures now in DeFi because of regulatory considerations, especially if you're in the US. You probably want to be anonymous or pseudo-anonymous. You probably want to decentralize as quickly as possible. And I think, so in certain instances, that makes sense from an innovation perspective, but not always. And this is why I say, people need to be, they need to be pragmatic, not dogmatic. They need to be considerate about consequences and outcomes. Specific to the question around money, again, over the last 7.5 years, I've been through a lot of cycles, as I'm sure many of the people listening to this have, perhaps mostly in 2017. On the one hand, a huge amount of money was invested and wasted in the ICO cycle. Like a lot of projects that should have never had any money got a lot of money. At the same time, a lot of really great things got built. And so on the surface, it might look like this very inefficient allocation of capital. But I would also argue that at the same time, a lot of things got built that would have never got that amount of money from a VC for a couple of things. Firstly, they were too ambitious. They were too blue ocean. They were too almost philosophical in scope. But also they were building open source protocols. Like VCs didn't know how to invest. It wasn't interesting to invest in open source, firstly. And even if it was, they couldn't invest in tokens and tokenization. And so I'm actually really proud of the amount of open source technology that got built during 2017, 18, 19, 20 that would have never got financed otherwise. Yes, there are a load of scams. Yes, there's a load of money that got given to people that, rather than building anything, basically started to just invest in crypto and act like a fund. Some of them even became a fund. But I think overall, it was a net beneficial outcome for Web3, and as a consequence, the internet, and as a consequence, the world. Now we're in another bull cycle. It is a seller's market, i.e. it's very easy to raise money as a startup, especially if you're in NFTs and DeFi, especially if you're in the metaverse, and especially if you've got a token. But I think that the market is a bit more disciplined now. And most of those projects are more likely to happen because the infrastructure is there to enable it. In 2017, people were raising money for use cases that you just couldn't do on Ethereum. It was like impossible. And maybe you can't even necessarily still do it now. So I think the fundamentals are much better. We've got a much more mature stack. We've got multiple protocols now emerging, things like Polkadot. We've got different approaches that you can take to taking a project to market. And so I think everyone's, as I said, a bit more disciplined. I think there are more fundamentals, more ways of benchmarking a project, a team. And to be blunt, there are a lot of people who raised money in 2017 that will never raise money again because they screwed people over and they didn't execute. And so I think whilst there are going to be new bad actors that join the space, I think there are a lot of people, and this includes investors, by the way, there are a lot of people who invested in things just to flip a token. Hopefully those guys don't get to play this time. But this is what financing innovation looks like in a permissionless system. It's messy, it looks inefficient, it looks ineffective, but I think ultimately it's net beneficial.
Right. Yeah, and when you spoke about, the open source material, it's interesting because there's still right now really little support for this. And a lot of people, they see this material and they still don't know what to do. They're still figuring it out. So it's interesting that you mentioned that. And, I was listening to your talk with Non Fungibles earlier. And, with the NFT space and everything, it's like there's a significant amount of trades in collectibles in comparison to art, but rarely anyone knows about that. And a lot of people just kind of flood into the art market. And it's because, even with this network effect, it's surprising that there's so much data that people don't look at, and simply because we don't. And it's like you said, it's messy. There's rarely any structure or fundamentals. So it's very interesting to see how this space is going to evolve and how people are going to choose to or decide to invest in this space. And just on that, as you said, I was doing this interview earlier with Non Fungible. They've got some great data. They just released a report, well, not just, I think a few weeks ago, maybe a month ago, on NFT data for 2020. I mean, of course, like even just what's happened since they probably released that report, the market's grown by 250, 300% or something. But one of the interesting things that came out to that interview, I thought this would happen much later, is I thought maybe 12 months down the line, apparently it's already happened, is NFTs as an asset class decouple from crypto. So what I mean by that is the price of NFTs, like generally or specific to a category, so collectibles or art,
detaches from the price of Bitcoin and Ethereum. So just because Bitcoin goes up or down does not affect the price of NFTs.
Right.
Or even the idea that because of growth in NFTs, even for crypto protocols that aren't really associated to NFTs yet, that NFTs could drive market growth in crypto generally. So
Right.
not only could they decouple, but they could become a driver for crypto. And according to nonfungible.com's data, that's already happened. It already happened in February, which is insane if you think about it, because what that means is that NFTs generally, and we've only just got started, right? As you say, it's primarily art and collectibles, but we're soon going to have a huge amount of gaming NFTs coming through. We're going to have audio NFTs coming through. Right. It's almost limitless as to the amount of different types of non-fungible tokens that we're going to have. Right. But the fact that they've already decoupled as an asset class means that they have a really strong likelihood of becoming a very powerful alternative asset, full stop. Right. So that was fascinating that I heard today.
Yeah, it's interesting because a lot of new people coming into space, and especially big names in the space, they're coming straight from, Bitcoin, Ethereum, straight into NFTs and skipping DeFi, which is insane. Like, you see people like Chamath and it's crazy. So what do you think? Like, why aren't mainstream institutions adopting crypto or NFTs as quickly as they should be?
Yeah, so I'd answer that in two parts, right? So firstly, I think the great thing about NFTs, I did an article on this in October last year, was that everybody can get NFTs. Like for the first time, everybody can get crypto because NFTs are a form of crypto. They're an extension of crypto, but the use case is understandable. Like the behavior of collecting, like most people don't understand money. Most people were never going to go to Binance and buy Bitcoin or ETH, and especially, more exotic crypto tokens that require them to understand what is Matic and, why is value going to accrue there or any other protocol, right? Or why is Polkadot, an interesting alternative to Ethereum? Like that's a very small niche of people that are ever going to understand that. And to be honest, you should ever be investing in it, right? Retail should be investing in that kind of stuff generally. Don't invest in things you don't understand. But with NFTs, all of a sudden you're saying, well, it's like a digital instance of it. It's a digital print or edition of an artwork. It's with an audio NFT. It's like a digital LP, right? It's a unique thing. It belongs to you. You collect it. Has provenance. Right. A gaming item. Gaming's already a huge multi-billion-dollar industry. The idea you can have a gaming skin, but that could be sold or used off a particular platform. Like people get that. So NFTs are the gateway drug to Web3 and crypto. And so what I mean by that is, I've experienced this as an art collector. I've got something called 100x Discord server that I'm involved in. And, similar to Whale, it's a community of collectors that are buying the kind of spectrum of art or collectibles in the NFT space. And I'm finding artists, like established artists, or even just, professionals working in advertising, visual communications, that discovered NFTs as a way to monetize their work as like a part-time thing, but that then have had to figure out, okay, well, how do I use MetaMask? Right. Or well, wait a minute, I've got to receive ETH. Well, okay, well, I now need to be able to exchange that for fiat. Okay, well, I have to go to Binance or I have to go to Coinbase. So as a consequence of NFTs and earning digital wealth in that form, they are having to begin to explore crypto. They're then understanding principles of custody and self-custody. And then interestingly, to get to your point around DeFi, they are beginning to, once they have a certain amount of value in this, that becomes a form of collateral. And so I think they discover DeFi by realizing that they then want to borrow and lend against this thing, right? This is why like NiftyFi, They're doing really cool things around borrowing and lending against NFTs. I think, increasingly, so if you think about digital wealth in a gaming context, like a traditional gaming context, right? There's a whole generation who have invested a huge amount of time and money in playing Fortnite or Metal Gear Solid, like any other game, especially like massively multiplayer role-playing games. And all that wealth is stuck in a platform, right? They can't get it out. And, it's very difficult for them to even cash that out in fiat, let alone anything else.
Right.
So all this wealth's trapped. And you've got a whole generation whose primary wealth is digital. And they are financially excluded. They can't get a house. They can't get a mortgage. They might have $1 million worth of in-game items, and they couldn't get a mortgage on a house worth $250,000, right? The bank's not interested. The minute that you allow people to unlock digital wealth and turn it into a financial asset that can be freely traded in the secondary market, you can begin to borrow and lend against it. And I would say by the end of 2021, somebody would have got over $1 million mortgage on a physical property using NFTs as collateral. Whether that's over collateralized or under collateralized, I don't know.
Right.
But that's going to happen. And when that happens, that's going to be massive. Equally, you've got people in Axes, right? You've got people doing play to earn. They're in the Philippines. They're earning their main income. Sorry, I've got somebody trying to phone me on my phone. Let me just turn this off. They've tried like 50 million times. I'll have to tell them off next time. So you've got people in Axie Infinity who are doing, play to earn as a main form of income in, say, the Philippines. Like that's how they pay their rent. That's how they, put food on the table for their family. And increasingly, these people are earning Axies, they're earning collectibles, and rather than sell them, especially if they need them for play to earn, they might just want to borrow on them. So it might be like a temporary loan just to pay the rent or, to pay a bill without having to sell the underlying asset. So I think everybody that comes into NFTs eventually is going to start looking at DeFi as a means to realize that as a proper form of digital wealth and as probably an increasing form of how they pay for things in the physical world. Right.
Yeah, it's interesting that you mentioned gaming because in a lot of paradigm shifts in the digital economy, gaming is kind of the gateway for them. And so my question to you would be, in the next 10 years, as we're moving into more of a service economy, and like you said, moving back to the question that we had earlier that we discussed, establishing the identity, do you think that with NFTs, with collateralization and fractionalization, do you think there's going to be like a more like a service-based thing? Like, let's say like ERC 1155 and people are selling like consultation, selling consultation for someone with that, or like selling, let's say like, I'll help you book a ticket, or do something for you with this, where do you think NFTs are going to go in the next 10 years?
Yeah. So again, a really good question. And I think it's a really interesting area that not a lot of people are thinking about. So currently they're thinking about NFTs as, this collectible thing that you keep in your wallet. And maybe you display on OpenSea, maybe you display it in a virtual world. I think increasingly NFTs will become social objects. So rather than just being a virtual good, they can allow for virtual services. So as you say, this could be a NFT that is redeemable for access. It could be like as a ticket, it could be access, either a one-off or perpetual access to both a virtual or a physical experience or service. Right. It can be redeemed for these things. So for example, we're playing around with, we have some Outlier Venture crypto beverage cans. And if you've got it in your wallet, you can access my calendar and you can book in time to do a pitch session. And the idea is we're going to give these to VIPs in our network that they can give it to other people as a form of social currency. So we've got venture partners who recommend startups to us. We're going to give them some cans. They can give it to startups that they like. And effectively, those startups get to jump to the front of the queue of the 2,000 startups that speak to us a year to directly book in, an hour of my time or half an hour of my time in the calendar. And I think that's just like the beginning of it. I think what's really interesting about NFTs is to think about them in a context of loyalty. So if you look at Aave and Aave Gotcha, DeFi is incredibly promiscuous. How do you, other than just giving people unsustainable yield, how do you lock liquidity in a platform? Well, if you allow them to earn effectively loyalty points in the form of collectibles with some kind of game on top, you can begin to have a form of loyalty. So it's also NFTs as a form of marketing. So I always say, and I wrote a post on this, it was called DeFi plus NFTs. Again, I think it was like October time. And I said, so on the one hand, NFTs will become collateral in DeFi. On the other hand, NFTs will close the loyalty loop in DeFi. So you can give yield by effectively giving away supply, your monetary supply of the underlying unit of the economy in a particular token economy or protocol. But you can't do that forever, right? It's unsustainable. You just debase your economy. If you do yield around campaigns to acquire new users, and then you use NFTs as a form of loyalty on top, then the combination of those things allow you to almost have this CRM tool, this DCRM tool. And so I think looking at NFTs in the context of access to digital services, experiences, loyalty, like redeemable things that are redeemable for loyalty is really exciting. And again, that's why we were very, very keen on Boson Protocol, because the guys behind Boson Protocol, this digital to physical redemption thing, actually built a $1 billion plus unicorn on loyalty points with airport lounges and MasterCard and American Express and Visa. So I think, redemption, loyalty, and all these kind of things is going to be a really interesting thing to be coming through with NFTs as well.
No, 100%. I think it's going to be really interesting to see even the gamification of, tokens and NFTs and see how that grows. Yeah. Jamie, thank you so much for answering my questions. I left to just take like 10 minutes to answer, like the community questions and what Whale Shark has to ask as well.
So I didn't know who's here, man. Hey, man. The big man himself.
This is, yes, the big man himself. So this question is from Whale Shark. The decentralized use case for music. Why NFT versus decentralized revenue streams for payments? Consumers are used to streaming, but the issue is with the revenue model, which can be solved through basic decentralization practices. Are NFTs going to solve the issue with the monetization of music, or are they going to be an add-on?
Yeah, so the honest answer is I don't have the answer. I think, so we've got a couple of music-based projects in the accelerator at the moment. We've got Cypher, which is allowing you to mint freestyle raps over a beat maker, and it turns it into an NFT. And then we've got another project which is linked to emanates around kind of digital streaming, decentralized digital streaming. But then they've also got something, the new name is, I think it's Moda. Yeah, Moda. They're just doing a branding at the moment. And they're all speaking to different management companies. So for example, Emanate working with deadmau5 and deadmau5 Management Company. And there's several others linked in the space. So on the one hand, the streaming business or economy is broken. It doesn't work for artists. Yeah. And what you're seeing is a large amount of private equity firms now are buying up artists' back catalogs in order to, generate the yield from streaming revenues. Right. And it's inevitable. Those private equity firms aren't doing that in perpetuity. They're doing that because they know they're going to probably be bought by Google or Facebook, right? So the question is, whilst we have a handful of platforms streaming music at the moment now, which are monopolies in their own right, do we really want Google, Apple, Facebook to own the music industry? because they will. Like, they're going to be trying to buy these back catalogs from private equity firms.
Right.
They're going to be buying the streaming platforms. Streaming only works for like 1% of the top artists, and 99% of artists, and it only barely works there. And this is because if you think about what the internet has done to music as a thing, so digitization has brought huge value, right? It's allowed for global, universal, non-stop distribution of digital things. Like, anybody can listen to any music 24 hours a day, near to the cost of free, on any device. It's like ubiquitous. The problem with it is that music is now just something you consume. It isn't something you own or collect. And there's a reason why LPs, for example, have not only retained value, but have increased in value the more music has become digitized and the more it's become streamed. Because people want to collect music. They want a relationship. They want an artifact that has provenance, that has scarcity. They want to be, there's a status associated with being a collector or an owner, part of that edition's journey and story and provenance. And so what I know for sure is that NFTs restore a lot of value to music, where previously it's pennies and pence. People listen to songs abstracted from even an album. You know, they'll listen to a mix of individual songs. The idea of a concept album is dead, right? Pretty much dead. I think LPs are going to allow artists to have to become their own platform, right? So rather than streaming through a platform, the artist is the platform. They get to set, so creator is a platform. They're going to set the terms of how people can interact with this asset, both in terms of it being a multimedia asset, how you can experience it, but also the underlying economics and in perpetuity outside of any one platform. So I think digital LPs are going to be huge. Does that mean that every song that is streamed is an NFT? Maybe not, but I would also argue potentially, right? Because, so I know one of the projects that we're working with, again, if I get the name right, I think it's Moda. But Emanate, if you follow Emanate, you'll see them talking a lot more about this shortly. But what they're doing is they're working on DAOs, where the DAO can effectively, an artist can sell their back catalog to a DAO that is owned by fans. So the fans own the underlying IP, and they can then generate they can share in the revenue from that through streaming. Now, exactly the mechanism through which, is that an NFT that is then streamed on streaming platforms, I don't know. But I think what you're going to end up with is NFTs fundamentally redefine what it means to be a creator and be an owner of things like music, not just music, but any media that has been digitized. Because as a creator, I can set the terms. I can this device, as I mentioned. So let's say you own my single. Let's say I'm Deadmau5, and I create a platinum album, a platinum single that's sold exclusively through NFTs. It's a limited supply. I can then say, well, if you own that NFT, if it's in your wallet, you can access my concert in the metaverse. Or it serves as a ticket for you to get into my next concert, right? So the NFT, not only is it an asset, is it an artifact, it becomes the mechanism through which an artist can directly control their relationship with their community outside of any platform. And so I think that that's just going to be fucking huge, right? Not just the value of these things, and there will be a platinum, there'll be a platinum NFT, I can guarantee you, in the next 12 months. Hopefully one of our projects is the ones that does it. But, I'm speaking to like several, probably next week, hopefully we'll have one of our projects announce that they've just taken money from some major music record management companies for artists that are looking to divorced themselves from record labels. If you look at Kanye West, I'm sure he's probably a bit distracted with everything that's going on with the divorce and everything else. But even 6-7 months ago, he was saying he wanted to create templates, contract templates, where artists didn't need a record label anymore. Right? They could, if they had like a set of 8 contracts, and they knew that they could configure them slightly, they could own their own music. And you've seen this stuff happening with various artists where, you know, they've fallen out with either their management company or the record label. So it's not a big stretch to say, well, you can make these contracts smart contracts. And then effectively it's a combination of smart contracts that can govern rights and royalties between an artist, the people that they collaborate with, other musicians and artists, and people that add value to their value chain. So it doesn't mean that maybe we get rid of management companies or we get rid of record labels, but you know, the relationships are governed through smart contracts, and the output are these kind of digitally scarce assets as NFTs. So I don't know if that answered the question. It was a bit of a ramble, but I don't know exactly how, but I know it's going to happen.
Yeah, it's interesting. You know, when speaking about the streaming platforms, rarely anyone actually talks about ecosystem loops or platform network effects. You know, with what audio stream, these decentralized audio streaming platforms have, is they have a cross-sided network effect at the ecosystem level. So it's like an endless supply of like, you know, supply and demand, because the users, a lot of them are actually the creators. You know, they get snippets of these big, you know, names in the space. They get snippets of they have a chance to own them and then play with them, or then create their own tracks. So it's going to be really interesting to see how that's going to play out.
And they're also curators, right? And again, this is something that's kind of missed. Like one of the whole things about being a collector is that you are a curator. You're providing a social function. And at the moment, people are either knowingly or unknowingly curating music on streaming platforms. They're training an algorithm to do the curation, or they're creating a little playlist, but they're not like monetizing that. And I think, again, the minute that you see a music file as an NFT as a social asset, in a way, almost a meme, right? It has a life cycle. Fans play a role in that, like DJs play a role in that. Because a lot of this stuff will start to happen on chain, you will start to see somebody who can say, look, because I bought and played these audio NFTs, or I somehow curated them, put them into a list, or potentially other people sampling them, you know, all of this stuff means it can be tracked on chain. And if you are an actor in the space that's providing value, you can quantify that. And then you can engage an artist and say, hey, look, don't take my word for it. You look at my on-chain data, look at how I've increased the value of this underlying IP as an NFT, either as a single NFT or multiple. And therefore, you know, cut me into your next track or album via a smart contract where I get some kind of royalties based upon participating. And I think, you know, like the stuff that you guys are doing with Whale around, you know, social currencies and stuff, I think is super interesting to anybody in the creative industries, well beyond art, right? I think it applies into music, potentially film, how things are financed. You know, can somebody raise money directly from their community, as they've been doing through crowdfunding platforms, through bonding curves, you know, based upon the level of risk in them executing an album or a movie or anything else.
Yeah, it's crazy that people are going to be able to market them in that sense as well. It's going to be insane. So yes, this is going to be a question on entrepreneurship. Entrepreneurship is a subject in the mouths of many. Nowadays, being an entrepreneur is something many are into. In your experience, you might have seen many failures and many successes. Could you name which patterns you have noticed that make a project succeed, and 2 to 3 things you would, for you, is just going to lead into failure?
Yeah, I mean, it's a hard question because, in all honesty, it isn't always easy to spot the person that's going to get a home run, because sometimes, as I said, it's a lot about timing. You know, you can have the best entrepreneur there and they could just be too early, or, you know, the market could collapse. They don't raise enough. There's so many variables that inform it. But as I said, at the same time, like, we do back founders over ideas. And so, for us, we prefer founding teams. We prefer co-founders because you get a complementary skill set. It's very difficult to find somebody that has all the attributes that would make a successful startup in one person. And even if you did, people are fragile things. Entrepreneurship really hard. It's like mental health of entrepreneurs is really tough.
Right.
The impact on the family and all these various things. So I think, founding teams are always preferable. And for us, in the context of Web3, what we're looking for are ideally a technical founder and a commercial founder. Now, we don't bias towards people who are from the Ivy League and, they went to the right college university. We don't even bias towards like seniority, right? The idea that, well, somebody's got 15 years experience in this particular industry. What we bias towards are character traits, because what we found is people like the right team, with the right mix of attributes can pretty much solve any problem, even if it's a problem that's new to them. Like ideally they are their user, so they have first-hand experience of the problem they're trying to solve. And if they are that and they're passionate about it, then it doesn't really matter whether they've got 20 years in that particular industry necessarily. They have proximity to the problem. I think the other thing is that there is a fit between the founders, and to extend that idea, there's a fit between the founders and the market. So you often see a lot of founders go into a market because they think it's going to make them lots of money. And that might be true. But the problem is there are going to be some lonely nights when you're trying to solve that problem. And if it isn't something that you're passionate about, those lonely nights are going to be a lot harder, and you're more likely to quit, fail, get distracted, move on to something else. So, what I always say to teams, especially now they can raise money easily, is pick a problem that if you spent the next 10 years solving, and even if you made no money doing it, you would have enjoyed those 10 years. Because you might not make any money. You might go for 3 years. You might nearly bankrupt yourself. Your wife or husband might leave you. You might put yourself into an early grave. You might develop health conditions. Like, it's going to be brutal, right? Being an entrepreneur is brutal. So for you to put yourself and your dependents through that, it needs to be something that you're going to really enjoy. Because if it's only money that's motivating you to do that, money might be the last thing that you ever get from doing it. So I think, passion to the thing, to the customer, the person you're going to having to be interfaced with. Like, if you don't want to be spending your 10 hours a day speaking to those type of people in that market, like that type of customer, don't do it. A good mix of founding team. And to be honest with you, I found like a lot of people think good founders don't go into accelerators. And I would actually argue the opposite is true. And I would say that firsthand, because I, as an entrepreneur, never went into a founder when I was younger, in my 20s, because I thought I knew everything. And I was too embarrassed to myself and to others to acknowledge my weaknesses. And therefore, I didn't compensate for them. I didn't hire well. I failed more than I should have done. And what I found is one of the consistent qualities of founders that join at least our accelerator is they're joining an accelerator because they know what they don't know. And they want to fast track learning. They don't want to make mistakes on their own. They'd much rather speak to people who can help them avoid mistakes. And I found that people join accelerators as a consequence of that. They're more self-aware, and therefore they hire better. They make better decisions. So that's kind of another thing. But maybe to just close off, the reason why I think it's especially true that you need a technical founder now a good CTO in a bull market is, it is almost, so if you are an entrepreneur with a great idea and you've got great access, it is almost impossible to find a great CTO in Web3 that like knows Solidity or whatever. These guys, you know, they can either command their own number. They've got lazy because they don't need to work. They're making so much money flipping crypto punks or like building their own DeFi protocol. Like, why do they want a job working for somebody else, or even sharing the pie 50%? So we found that we don't do it anymore. Projects that enter the accelerator program without a great CTO already are at a massive disadvantage. They're going to spend, given we're only working with them for 3 to 6 months intensively, they might spend 3 months of that program trying to find a CTO,
right?
Or have to outsource lots of it to a third-party dev shop. So for us, it's a big red flag at the moment. If it's just a team of commercial people, it doesn't matter if they've got 5 industry veterans with the best CVs on the planet, and even if they've got a couple of million in the bank, like that is often still not enough. You need to have been able to have convinced a great CTO in the space that this is interesting for them to spend their time on it, and that's like half the battle for a commercial founder.
Yeah, and as you know, like, you know, when starting a business, you know, there's a lot of inflection points when taking off. It's like you want to find the right people in the company where, you know, I like who can get me to where I want to be in 2 years when it would take me 4 years. And so if they can't, then maybe they should, you know, go to founders or go to Accelerator and see what they can do with that. But that
and a big part of, you just underlined like what an accelerator is. On the one hand, we've got like 20 plus full-time staff with various specialties, from token design, securities law, structuring, brand and marketing, you know, the nuances of a token launch and building community and all that stuff. But actually, that's just a fraction of the value that you get from something like our accelerator. The value you get from our accelerator is primarily our network, right? So as I said earlier, like the first 2 weeks of the accelerator, you are pitching every day for 2 weeks.
Right.
I think we've done it sometimes where people have pitched to over 200 investors.
Right.
And the reason for that is you get immense feedback loop right at the beginning. So rather than raising some money, a little bit of money, building something, and then nobody else giving you money for it, it gets just pulled apart. Like in the first week, people hate it. They're like, oh my God, what am I doing here? I've just been told my idea is shit by, you know, 50 people. But once they get used to it, they get used to telling the story, the idea hardens, they understand what other people are interested in. Like we've just fast-tracked 6 months of fundraising in about 2 weeks. The next thing is we bring in awesome founders. So people like Whale, for example, a lot of the founders that I have on, the founders of Web3, people who've done it, they understand the nuance of building in Web3, they understand of fundraising, the understanding of being a leader, a community leader in the space. You know, we get these projects access to these founders. They do founder one-on-ones and drop-ins. So basically what I say is in 3 months, we've given you, you know, 18 months of experience that would have cost you millions. Like for you to learn that stuff on the job would have meant that you're spending millions in wasted time. So, and time actually is the most precious thing, more than money, right? If you do have something that's of the zeitgeist, no concept is unique now. Like we're all one hive mind with the internet. You might think you have this really valid, unique idea. I can guarantee you at least 10 other people have got it and they're executing on it right now. It's all about execution. So if you can fast track how quickly you can get that to market and raise money, you have significant odds of being the one that wins.
Yeah. And I feel like, you know, especially when you're pitching to so many, like, you know, so many investors at the same time, it's not going to be hard to differentiate like between the bad and the mediocre investors. And you know, you get familiar with storytelling. And I say quite often, you know, being a storyteller is actually a huge advantage when it comes to becoming a founder. Because people listen to what you have to say, you have to be convincing. So it's interesting, especially now, you know, with everything being online. You know, when you pitch, you have this small window on Zoom, and it's like you have to make everything so much more compelling just to keep their like attention.
So I always joke that startups are best thought of as cults,
Right.
And they're normally death cults, by the way, because most 90% of startups die. And like in their first 2 years, 90% of startups will die. Now, we've got an amazing hit rate. I think we've only had over 35 startups we've worked with in 7 years. We've only had 2 outright just like not make it after their first year, which is a pretty good hit rate. But startups are pretty weird things, right? They're an idea. Like, they don't actually exist initially. You've got a concept. You're convincing other people that this concept is like you have a vision for the future, and you're convincing these people to build that vision.
Right.
And everybody's fully aware that it might not be true. Like, your assumptions about that vision might not be true.
Right.
When you're getting people to give you money to donate to your vision, donate to this group of people you've convinced to be part of your ragtag. And in startup life, the team will spend more time with one another than they will with their families. I mean, the startup basically takes you away from your family. They are cults. And so the best way to think of a startup founder is as a cult leader. And I think that analogy extends now in the Web3 and token space, because very quickly, most projects are public companies, right? If you think about classic companies, most never go public. They stay private companies, because being a public company is a pain in the ass. Like, all of a sudden, on a daily basis, you have to convince some idiot in a Telegram channel that you're not a scammer. And actually, startups are hard, and you are executing on something. And so you've got like thousands, hundreds, thousands, tens of thousands of unsophisticated retail investors who just want the price to go up. And so that is like really hard. And so, as you say, being able to be a community leader and almost in part politician, you could argue Vitalik is a politician more than anything else. But I think if you look at what Whale does with Whale Shark, I mean, it's a perfect example. Of course, Whale is a community, but it has been catalyzed and it is led by Whale. And the strength of his personality, his principles. I've done an interview with Whale on my podcast where he talks about constantly and very clearly communicating his principles, like what are things that are important to him. And of course, that's especially true when you're pseudo anonymous. Like, how do you get people to trust you when they don't know who you are? Web3 startups are cults, but Web3 startups are like mega cults.
I was speaking to someone the other day, and I was like, businesses, here are like cults, and if we're going to make a cult, then you got to be the best damn cult there is out there, right? So, so Jamie, thank you so much for joining us. It was an absolute pleasure speaking with you. I would love to have you on again sometime, especially with how the NFT space is growing. There's probably going to be so much that has changed. If someone, people would like to find you or follow you, where can they find you?
Yeah, well, so firstly, thanks for having me on. I must say, it was one of the best interviews I've done. You clearly really did your research and really thought things through, which is quite rare, to be honest. So I really appreciate you having taken the time to kind of prepare the questions and think this through. Hopefully the community enjoyed them. So you can find me on Twitter personally at Jamie247, 247 the numbers. You can find Outlier Ventures, outlierventures.io. The accelerator I talked about was outlierventures.io/basecamp. For later stage projects that are about 6 to 8 weeks away from launching a token, you can go to outlierventures.io/ascent, ASCENT. But you can also find Outlier Ventures on our YouTube channel, youtube.com/Outlier Ventures. We create loads of content there, from token design. I interview people like Whale, also analysts. I just did one, as you said, for Non Fungible on NFT markets. And you can follow Outlier Ventures on Twitter at OVOIOHQ.
We will link all of those in the stream text later. And again, Jamie, thank you so much for joining us, and make sure to check Jamie out.
Thanks for having me.
See ya.
Bye.